Good morning and welcome to Jeff's World, the weekly 30-minute show where our goal is to help you make more informed investment decisions. I'm not on camera today because I'm having a little bit of internet difficulties, but we've got the rest of the team on camera today. We're going to cover some key opportunities and risks for investors tied to developments around the world. There's plenty of those going on. Of course, we're also going to take your live questions from the chat on YouTube, so you can ask us what's on your mind at any time by entering it in the chat, and we'll get to those questions in a few minutes after we share some of our latest insights. Now, of course, we've got a lot to cover, but first we've got a few required disclosures before we get started. We don't know you personally, so we don't make personalized recommendations, but we do talk generally about the markets and the sectors and the areas of investing we think are likely to perform well or poorly and why. And of course, things can and do change, so all the thoughts we share are subject to change as well. And of course, investing has risks, and international investing has unique risks like currency moves, so please keep all that in mind. Of course, as is the case every week, I'm joined by Michelle Ghibley and Heather O'Leary. They're both on camera. They're from the Global Strategy team here at Charles Schwab. Good morning, ladies.
Good morning, Jeff. Good morning, Michelle.
Good morning, everybody.
So as typical, I will be watching the chat and questions closely, and we're going to get to those in just a little bit. Jeff, go ahead and kick us off with a quick rundown of what we're watching this week that can move the markets.
Yeah, so let me give you a quick 90 seconds on what we think can move the markets this week. So Sunday saw Canada's Liberal Party elect a new prime minister to succeed Justin Trudeau. And the new leader, Mark Carney, will be sworn in earlier this week. Of course, he's a former central banker and pretty widely respected technocrat, so we'll see what that means. He's already talked about some of the changes he'd like to make in the Liberal Party's platform here, getting rid of some tax increases, actually talking about cutting taxes, increasing government spending, a lot of interesting things going on there. On Monday, today, China's retaliatory tariffs, as high as 15% on U.S. agricultural goods, are taking effect. Also, the European Union finance ministers are meeting in Brussels today amid efforts to boost defense spending, with potentially some impacts on GDP growth and inflation and debt there, in response, of course, to the U.S. signaling reduced support for European defense and maybe rebuilding ties with Russia. Now, we've got a new week here, so we've got some new tariffs. Wednesday marks the U.S. deadline to impose 25% steel and aluminum tariffs. Of course, they could be delayed or altered, has been the pattern. Also, the U.S. Consumer Price Index, CPI for February, is going to cover the first full month of President Trump's second term as the Federal Reserve Communications blackout period, where they avoid making comments, begins ahead of that March 19th policy meeting. And also here on Wednesday this week, the Bank of Canada is going to meet on rates with a quarter-point rate cut anticipated. On Thursday, we've got the White House imposed deadline for agency restructuring proposals and mass layoff plans to be presented fresh after last week's jobs report for February, where we did see some impact there, federal hiring being reduced. And on Friday, we get the deadline for U.S. lawmakers to strike a deal that avoids a federal government shutdown. That caps a pretty big week for events emanating from Washington. Now, Michelle, let's get caught up before we focus further on what's ahead. China's stock market was up 7% last week, and it's now up over 20% year to date. It's interesting to see that more and more we're seeing 2017 play out here in 2025. That was, of course, first year of Trump's first term, and we're seeing a lot of that relative performance play out here in 2025, with China is one of the strongest markets in the world. The U.S. is one of the weakest. Same thing happened in Trump's first term. Anyway, we had the National People's Congress meeting last week. You previewed that last week. What happened there, and why did the market seem so excited by it?
Yeah, we're seeing some trends overseas that are similar. Europe is looking at potentially increase fiscal spending, and China is too. They're increasing their fiscal deficit as a percent of GDP, and that's kind of continuing the more supportive stance for the economy that started in September. The thing is, though, that consumer confidence is still low, and there has not yet been a shift towards supporting consumption. The government is likely holding its firepower till they hear more on tariffs from the US, and so there's more room for stimulus later this year. The real change that we've seen is a shift in sentiment, and particular because there might be a more business-friendly environment. We saw a meeting between President Xi and tech leaders in February, and then last week there was some more supportive language that echoes that during the policy meeting. And so, there's also a lot of enthusiasm about the prospects for Chinese innovation in AI. We had the DeepSeek model unveiled in January, and then we've had several other AI models, Chinese AI models, and then just announcements from a really growing list of Chinese companies of all kinds, including state-owned enterprises, that are adopting AI into their business operations, which could result in productivity gains and increased earnings growth.
Michelle, when I hear about AI-driven stock market, and I know China's stock market is up 50% over the past year, so from March 7th of last year to March 7th of this year, that's nearly 5 times the return of the S&P 500 over the same period. And we know tech stocks have played a role in that. We know U.S. stocks are expensive, but Chinese stocks are not expensive now, too, or are they?
Yeah, you think back, it wasn't that long ago, all we heard was China was uninvestable. So there was a lot of pessimism, and that was reflected in the valuation. So if we look at the Chinese market as a whole, it's attractively valued. It's right around its 20-year average price to next 12 months earnings, and that's despite these big gains in the stocks. But again, as I mentioned, a lot of the gains so far has been a shift in sentiment, and we haven't seen as much shift in economic and earnings growth. So that could leave the stocks vulnerable to disappointment if business sentiment doesn't also follow and businesses don't start boosting their investment and hiring. Now, Chinese markets, they tend to have a bear market at some point during the year, almost every year. So investors might want to keep, a long-term view toward investing and keep their positions small in size.
Well, that's a good point. So thinking about last year, so I just said, stocks are up nearly 50%, but we did see some pullbacks during that period of time, right? I mean, Chinese stocks are highly volatile in part because it's such a policy-driven environment, and there's not a lot of clarity often, when new policies are being formulated. They're just sort of announced, and then the market reacts kind of dramatically. So interesting to see. Incredible performance over the last year, but you can see kind of the ups and downs. You've got this chart here, the PE ratio. It's sort of interesting to see. There was a period of time where, China's growth was considered, worth a premium. And now, in recent years, gosh, if you look over the last 10 years, it's most often traded at a discount to its history. So interesting to see here in what's shaping up there. But let's talk about what's happening in China now. In a broader sense, when we look around the world this year, a main driver of the stock market this year appears to be President Trump's America First policies. Yet, it's the international stock markets that are coming in first, with the MSCI EAFE index, the index of developed international stocks. Doesn't include China, includes the rest of the world. We know China's doing great, so emerging markets are doing great, but the developed market is as well. In fact, it's off to its best start in a year in more than 25 years. Heather put this chart together, and because my idea of doing it had just 25 different lines all over it, but this is much better, much easier to see how strong the year-to-date gain in the EAFE index is. Best start to a year in 25 years. It doesn't even include China in that developed market index, and that's come even as the U.S.'s S&P 500 has suffered losses this year. In fact, America First policies has kind of put America last year in terms of the stock market performance this year. Trump's policies seem to be driving pro-growth shifts in Europe and Asia, even as they're driving some turmoil here in the U.S. I've mentioned many times, but the biggest exporters from Canada and Mexico to the U.S. are U.S.-listed stocks like GM and Ford, not Canadian or Mexican-listed stocks. So we're seeing this again and again, where the on-again, off-again tariffs on the U.S.'s major trading partners seems to have created an environment of uncertainty in the U.S. And, we noted late last year that President Trump has a history of rapid changes in policy, and tariffs could come and go quickly, and that has certainly been the case so far. Those 25% tariffs on Colombia came and went in 9 hours. And, of course, the across-the-board tariffs on imports from Canada and Mexico were delayed from February 3rd to March 4th, and then given a reprieve of just 48 hours after they went into effect with a further delay until April 2nd. So it's a fluid situation. U.S. tariffs could change again later today, this week, this month, next quarter, definitely creating a lot of uncertainty for businesses. Now, the next date on the tariff watch is Wednesday, as I mentioned at the start of the call. Metals tariffs potentially kicking in that day. The aluminum tariff could also be delayed given the potential negative impact on U.S. manufacturers. Remember, the U.S. imports about 50% of its primary aluminum, and it's used to make things including airplanes and cars, which are areas where the U.S. competes on a global stage. So this desire to make good on his tariff threats might be balanced by Trump's desire to have a legacy of restoring U.S. manufacturing. So, Michelle, after that, after the metals tariffs this week, we get to the quote-unquote reciprocal tariffs set for April 2nd, right? Could that be delayed too?
Yeah, it's possible. April 2nd is the day for a report on these reciprocal tariffs. It may not be the day of implementation. These tariffs are, very complicated, and so they could be delayed. So, for example, instead of 3 categories for each of 17,000 imported products, there might need to be.
Let me stop you there
Yeah.
for a second, Michelle, if I can. So we got 3 categories, right? So that's like you've got most favored nation is one of the categories, and then we've got like bound tariffs. And then we've got, so there's like 3, because usually you're like, well, you've got a trade agreement with the U.S., or you're part of the WTO, or you're not, right? There's sort of like 3 categories for goods. It's not more complicated. Like there's a lot of goods, right? But there's sort of 3 categories. But you're saying that could really explode.
Right. So instead of 3 categories, there could be 183 different categories, one for each
Wow.
country. And you multiply that by 17,000 products and you get 3 million different tariffs. And, if we think back to the de minimis tariffs on goods less than shipments less than $800, Trump suspended those tariffs because they were too difficult to implement. And the thing is, as I just mentioned, 3 million tariffs, that would be orders of magnitude more difficult.
Yeah, wow. That's definitely a whole, 183 times is more challenging. Look, we just don't know whether this is going to happen or not. There's a lot of uncertainty. And the longer the tariff turmoil and related uncertainty around trade policy lasts, the more likely economic and earnings growth may take a hit. And we can see this in the relative performance of the economic surprise indexes this year. U.S. data is missing expectations. You can see that in the blue line here. It's below 0. That means data is coming in below expectations, and it's falling generally. I guess in the last week or so, it's ticked up a little bit, last few days, but it's been going down. And that's in contrast to the orange line. That's Europe, where it's been going up. Data is coming in better than expected and increasingly better than expected. So obviously this bounces around day to day with data points. We'll get more data points this week, but it's interesting to note the relative economic momentum and beating of expectations really shifting away from the U.S. towards Europe. With Trump threatening European auto imports with tariffs on April 2nd, these reciprocal tariffs, the European Commission proposed easing emission rules that were supposed to get stricter on autos this year, and that helped automakers, right? So that's kind of turning around sentiment. Again, it's these policies and the relative performance. Companies in the industrials and materials sectors in Europe have a brightening outlook on the prospect that Germany may unlock hundreds of billions of euros for defense and infrastructure investments. That's creating a brighter outlook. Many of these actions have been in response to the Trump administration's threats to target European auto imports with tariffs and to back away from supporting Europe's defense. German stocks are up over 20% so far this year, measured in dollars. So the outlook for a further rise in defense spending got another boost from the Trump-Zelensky meeting. We talked about this last week about how maybe there's a new Magnificent Seven. We've got this potential for a rise in defense spending. We just had the readout from the coalition partnership meeting that took place this weekend between the 2 sort of coalition partners in Germany after this recent election. And one of the things that came out of that was, sort of this formal statement of really picking up defense spending. And so it really looks like more of a sure thing, a relative sure thing in the markets. to bet on more defense spending in Europe than, say, AI or any of the other things that the market had been more confident in. And that's one of the reasons why we continue to see this incredible outperformance by Europe's defense sector. Here we're looking at the MSCI EMU, that's European Monetary Union, Aerospace and Defense Index, up nearly 40%. This was through Thursday of last week. I ran the chart. While the U.S.'s Magnificent Seven stocks are down about 10%. So this is a massive gap this year in what could be this new Mag 7, the 7 defense stocks in Europe versus the U.S.'s defense stocks. So again, a lot of this being driven by Trump administration policies, really making, in this case, Europe better again, Europe great again, and maybe China great again. We were talking about China, but if we go back to China, China's National People's Congress meeting pledged another 5% GDP target this year, a pretty ambitious goal given all the challenges, and a fiscal deficit target around 4% of GDP. So really talking about much more government spending. That's the highest deficit for the federal government in China in more than 3 decades. So, China's really tried to keep that to 3% or less, and so really willing to step over that line, increase it to 4%, really suggests China's taking quite seriously the need to reinflate its economy. As you pointed out earlier, Michelle, not a lot of details coming out in terms of, consumer support, a little bit on the trade-ins, maybe a little bit on housing, but they seem to be more committed here in terms of some of the overall numbers. So maybe we'll hear more coming out in the coming weeks or so. But just, again, this is all sort of in response to the trade policies and all that stuff, everything going on sort of targeting the Trump administration. I know you already talked about, some of the business-friendly environment in China, but it'll be interesting to see how this shapes up. I would guess that there's, more opportunities for China to roll some stimulus out here over the coming weeks and months. What do you think?
Yeah, I think, like I said, they're just kind of holding their firepower until they get more information about the tariff situation and maybe some back channel negotiations happening on TikTok and that kind of thing. I wanted to say one thing too about Europe is that the measures that were unveiled last week are really just historic in size and scope. They're not a done deal yet, but the shifting away from fiscal austerity and coming together and maybe act more like a union to strengthen economic growth, that's really a big shift in Europe.
Yeah, it's interesting. There's an old adage that kind of Europe moves forward one crisis at a time. We see this again and again, whether it's Brexit or whether it was the great financial crisis or the European debt crisis. It sort of brings them together, right? You generally don't have, concerns about the European Union breaking apart. And in fact, I think on the polling numbers, they've come way, way, way down. I think less than 5% of the population of Europe would, in any of those member countries, would want to see the country pull away. Even as we've seen a rightward shift in the governments, those parties have dropped the idea that they would leave the Eurozone. So it's just interesting to see how they're coming together there. And you're right, this could be a bit of a watershed moment. Interestingly, it'll be catalyzed by U.S. policy shift. But again, that's how things tend to work.
Yeah,
and look, it's not just. Oh, go ahead.
Yeah, the other thing, Jeff, is you mentioned a crisis. We had the Eurozone debt crisis in 2011, and bond yields spiked then. We saw a spike in yields in Europe last week, but these were for good reasons this time. Potential for an expansion in economic growth. German 10-year yield rose by 30 basis points just one day last week, and it prompted, the whole region, yields to go higher because, again, maybe we're going to see common debt spending this time.
Yeah, it's interesting. So even as yields in the U.S. have been slumping a little bit on the prospects for weaker economic growth in the U.S., they've been going the other direction in Europe. So clearly a sign that maybe growth is for real this time, and they're really kind of breaking out. Again, it's not booming growth, but it is stronger, better, as we often say, and more important than good. But it's getting good. It's not bad, at least, and it had been bad for a couple of years with Germany in and out of recession and growth every other quarter for the last 2 years, now finally seeing a bit of a breakaway from that. But it isn't just these Trump policies that are the only thing driving international stocks to post really strong outperformance this year. Even on a tough day like today, we're still seeing European markets outperform the U.S. And there are several reasons for this. Economic and earnings estimates are on the rise in Europe, as we just talked about, along with ongoing rate cuts by the European Central Bank, which made its sixth rate cut this cycle last week, and that's helping to lift price-earnings ratios for the equity markets on the back of this better growth. And it's been true in the past that pro-growth policy, tends to move forward this one crisis at a time. I'm not necessarily saying there's a crisis in Europe, but just the idea of the tariffs and just the uncertainties kind of catalyzing action within Europe. And I think it's really interesting, and it's really delivered great performance for international markets so far this year. So really interesting to see and encouraging to see, something we certainly previewed in our outlook for 2025, published late last year. All right, Heather, let's move over to chat Q&A and see what the questions are that have been coming in.
Well, one of our first questions is directly related to the performance that we've seen in international. Have we seen a flight to overseas stocks with the Trump threats and implementations of these tariffs?
To answer that question with data, we have seen, and I don't mean Schwab, I mean generally across the entire investment industry, there's weekly data that comes from the Investment Company Institute that tracks flows into mutual funds and ETFs, international ones and U.S. ones. So U.S. investors investing in, bonds versus international stocks versus U.S. stocks. And we have seen more of a flow into international equities and a bit of an outflow from U.S. That isn't always an indicator of anything in particular. Sometimes that changes around the end of a quarter because you get rebalancing in portfolios at the beginning of a year. So you almost have to kind of wait for a trend to be established to really see if that's something that holds. For a very long time, investors have been favoring U.S. equities over international. International investors have been favoring U.S. markets, moving more and more into U.S. equities rather than favoring their own domestic markets. That seemingly has started to change. And whether it's a long-term change or not, we'll have to see. But we have started to see a pickup in flows to international markets relative to the U.S. Not enough to suggest to us that there's a sentiment-driven move there, that investors have become too optimistic in international markets. Generally, you have to see a much more significant shift in portfolios, allocations, and a much longer trend and a sharper trend in money allocation. But we are starting to see that begin to move this year. I'd note that typically those investment flows tend to move with the 3-year relative return. So we've not yet seen, on a 3-year rolling basis, international markets outperform the U.S. In the past 3 years, U.S. is still outperforming international. But as we get to later this year and we cross the turning point at the start of the new bull market, which began in October of last year, that's the point at which we might start to see markets like Europe. Europe, assuming nothing changes in the stock market between now and October. I know it's a not likely to happen, but just assume the relative performance between the U.S. and international remains the same. As we get to October, on a 3-year rolling basis, international will be outperforming because we'll be dropping off, the 3-year returns where the U.S. had outperformed. My point is, later this year, we're going to see international stocks outperforming U.S. stocks on a 3-year rolling basis, most likely, assuming they don't even continue to outperform, we would see that. That's when you would start to see those portfolio flows really begin to shift and some real momentum towards money flows that could further support international markets. So while we remain positive on those markets here in the first half of the year, it's maybe the second half of the year, and notably in the fourth quarter, where those flows could really pick up if history remains a guide.
Thanks so much for that. Now, Jeff, you did mention the election in Canada, so now we have Carney as a prime minister. Do we see a better working relationship with Trump and Carney opposed to his predecessor?
I think you could not find two different personalities. So Carney is very much a technocrat. He was the Bank of England governor there. He's been a policymaker in Canada, but not an elected official. So not an elected official, but really a technocrat in the government running monetary policy. Whereas Trump is a reality TV celebrity, and moved into the political world. Very different backgrounds, very different styles. So you would expect some clash there. However, Carney certainly is maybe. How do I want to say this? Maybe a little bit more focused on pragmatically trying to figure out what might work, right? So it'll be interesting to see how this evolves. Canada, what he's announced this morning is major changes to Canada's Liberal Party, which is the current ruling party, and their platform, really talking about tax cuts, talking about reducing administrative costs, right? Doge-like, talking about and tax cuts, like the Republicans in the U.S., talking about more defense spending, talking about more infrastructure spending, a number of different things that are more energy growth and exports, more free trade agreements. So really kind of focusing on building Canada's strengths and a number, taking a little bit of a page from some of the U.S. policies as well. So maybe they're a bit more like in policies than you would expect from the Liberal Party and the Republican Party. And so they might find some overlap there in terms of actual policies, but personality-wise, they're very different. The Conservative candidate, there's an election coming. So the election that just took place this weekend was for the leader of the Liberal Party, which is the current ruling party in Canada. There will be a broader election to take place later this year. The date's not yet set, sometime between now and October 5th, where it will be a challenge between the Liberal Party and the Conservative Party in Canada. Now, it was looking like the Conservative Party candidate, Pierre Poilievre, would win. He's a bit more Trump-like in his policies and his personality. Now, with the sort of anti-Trump surge that's taking place in Canada, we've seen the Liberal Party move back into the lead in the polling. So now it's much more of a horse race between Carney and Pierre Poilievre in terms of who will be running Canada as we look to the second half of this year and who will be interfacing with the Trump administration. Still don't know, still up in the air, and that's why, these tariffs and all these issues, may continue to get pushed along until Trump knows who he's negotiating with, because, negotiating with Carney, if he's going to end up with Poilievre, would be maybe counterproductive to his negotiating position. So we'll see how that goes, but certainly a lot moving on here in North America from a policy perspective here over the next 6 months.
Yes, there is. Going off to the other side of the world, do we have an update on what might be going on in Japan with their markets and their currency?
Yeah, Michelle, you might want to chime in on this. So, Japan is generally a market that tends to move on the outlook for industry, right? So you've got an economy that's very focused on building things and shipping them around the world, very trade dependent and very manufacturing dependent. And so we've seen this manufacturing recovery this year, and that's helped to support generally the companies in Japan. One of the challenges to all of that is that the yen has been strengthening this year, and well, when you're an exporter, you like to have a cheap currency, right? Because it makes your goods less expensive in foreign markets. But the yen has been rising because of the rate increases that have been put in place in Japan that may continue this year. And the consequence of that is maybe the trade terms are a little less favorable. That may have weighed slightly on some of those exporters. So there's positives and negatives there. We've been positive on Japanese equities for years now, and they've done very well. Now they're maybe running into a little bit of a headwind of a higher currency. Michelle, what do you have to add to that?
Yeah, I think that the Bank of Japan is still on a hiking cycle. They're, in contrast to the rest of the world, they're raising rates this year as inflation is finally taken hold in a good way. They had deflation for 30 years. The currency, if you look at the 2-year yield for the Japanese government bond relative to the U.S., and compared to back in July when things really started to shift, the U.S. 2-year is down about 70 basis points, and the Japanese 2-year is up 50 basis points. So that narrowing of that interest rate differential is really lifting the yen. Back in last July and August, we had the unwind of the yen carry trade, where we had massively short yen positions. But now we're kind of in the opposite direction. We have very consensus view that the yen is going higher. And I just looked it up while we were talking here. It's almost the opposite situation in the, extreme yen long. So I don't know how much longer the yen can go up, but it's certainly consensus at this point.
Yeah, and it's boosted financials there as well. So financials, very big sector in Japan. They're up a bit here on higher rates and the steeper yield curve, something we haven't seen for a long time in Japan. So that's been on the plus side. All right, Heather. Well, thanks very much for those questions. Thanks everybody for your questions. Always make the show better. We're only as good as the questions we get asked. Thanks, Heather and Michelle, and our producers Andrew and Gabe, and everyone for the questions and for joining us. Tune in each week at 11 a.m. Eastern or catch the replay on YouTube. Also, be sure to click like on the show and share your comments on what you're watching in the markets, and we'll see you again next week.